What if the biggest risk in markets today is not a crash, but expectations that were never realistic to begin with? Because it is exactly what this chart exposes. Not fear, not panic, but valuation gravity. This is a distribution of historical outcomes, and that distinction matters more than anything else in investing. Today, I want to show you how to read this chart correctly, why investors consistently misread it, and why where we are today has historically delivered some of the worst forward real returns of all time. Let's define what we're looking for. This chart shows the distribution of 10 years of annualized real return. That is, return after inflation. Measure over a 10-year period, group by starting Shiller P ratio, the price to earnings. And the horizontal axis is valuation, and the vertical axis is frequency, not performance. This is critical. This chart does not say what will happen next. It shows what has happened historically when markets started at similar valuation levels. So let's learn how to read this. So the x-axis is basically the PE ratio. Lower value on the left, cheaper markets. Higher value on the right, expensive markets. So what we're talking about is basically the price to earning ratio. Right now, the price to earning ratio for, let's say, Tesla is around 300-400, believe it or not. The market PE is around 27. So this is showing you the PE ratio, how much investors are willing to pay for each dollar of earnings of a particular publicly traded company. It removes cycle noise. It is slow, it is structural, right? And on the y-axis, you're seeing number of observation. And don't forget to subscribe, thumbs up, become a member to help support the effort of this channel. You could become a member on Patreon channel, or you could become a member on YouTube. And I come to my members live every morning, telling them exactly what it is that I'm looking at, what I think is going to happen, or is happening. Anyway, so on the y-axis, taller bar means outcomes happen more often. Shorter bar means rare outcomes. So it's about probabilities. What are we looking at? The most important part. Now look at the colors. So the bars that are tall means the outcome happens more often, obviously, in the low bar. Now look at the blue bars. The blue bars represent periods where investors earn positive real returns over the next 10 years. And you notice that they are concentrated towards the lower P ratio. The red bars represent periods where investors earn negative real returns after inflation. Don't want to be there. And mostly you see the red on the side where the high P ratios are. So this is a punchline. At high valuations, red doesn't disappear, it grows. The left side of the chart, when markets were cheap, gap ratio is around 10. That is the Great Depression, 1940, and 1980. What do you see? Dense blue bars, very few red outcomes, high probability of strong real returns. This is math. It's not luck. Low starting prices mean margin of safety. Earning growth doesn't have to be heroic, and valuation multiples don't need to expand. I have shown over and over and over that you make money with low PE stock. It does not mean that you want to buy low growth stock. You want to buy low PE stocks. That is a secret. Now, when you go towards 15 to 20, in terms of P ratio, this is where investors get complacent. The returns are mixed. The returns are wider. They're less predictable. Still mostly positive, but lower average returns, higher dispersion, much more reliance on growth assumptions. That is where the narratives begin to matter more than fundamentals. And look at the far right. Ratios of above 30. This is rare territory. This is 1929, 2000, and of course, today. Look what happens. The blue bars thin out. The red bars become more frequent. Outcome dispersion collapses downward. At these levels, earnings growth must be perfect. Inflation must cooperate. Interest rates must stay friendly. History says they usually don't. So the red vertical line, this is where we are. As you can see, we are here. It's not subtle. It's an extreme. We're not slightly expensive. We're statistically isolated from most historical outcomes. At this valuation, negative real returns are no longer rare. They are historical common. The upside tail nearly disappears. This does not mean an imminent crash. It means future returns are being borrowed from the past. And why is it that investors ignore this? Well, because this chart does not fit the narratives. It does not predict the timing. It confirms optimism and invalidate leverage. It demands patience. It demands humility. It demands lower expected return. And most investors would rather believe this time is different. And history says it never is. What this chart does not say, sell everything tomorrow, markets can't go higher, innovation doesn't matter. It says starting price matters more than endings, long-term return are constrained by valuation, and risk is highest when confidence is highest. It means that if you want to make money in the stock market, you need to buy low PE stock, and to buy low PE stocks before they become high PE stocks. You need to find the growth when nobody else is seeing it. And as I tell my subscribers and my members on Patreon, you need to be first. So what does it say? Well, it says that the next decade is unlikely to resemble the last. Real returns are likely lower. Volatility will be emotionally harder. It says discipline will matter more than bravado. It says the biggest mistake is extrapolation. Remember, this chart does not care about your favorite stock, your macro view, and your timeline. It reflects one brutal truth. Price is what you pay. Valuation determines what you get. Ignore it at your own risk.